Hello, listeners, and welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Brief housekeeping note, I had a lot of podcasts scheduled this week to stack the podcast cadence going forward, but 3 different people canceled on me this week, so there won't be an episode at the beginning of next week like normal, but don't worry, we've got lots of guests lined up after that. You'll get a brief blip in the cadence going forward, but everything is fine, and Rob and I, of course, will be back at it next week too. Otherwise, not a whole lot of notes for me. You can reach me at jacob@cognitive.investments if you want to talk about this podcast or about anything that you think we should read or anything else going on in the world, or even our investment advisory services, things like that. Also, I'll start saying at the beginning of the podcast, I will be in Minot, North Dakota next week, Miami the week after that, and then in both Milwaukee, Wisconsin, and in Minneapolis in February or March. So if you are in any of those locales and want to get together or talk to me or anything like that, I've enjoyed meeting listeners in general, and I'll try to make some time. You can shoot me an email if you're in those places as well. So take care of the people you love. Cheers, and see you out there. We sent out some requests for question and answers, and we'll spend sort of the second half of the podcast doing questions and answers. But we'll start off. I mean, it was kind of I don't want to say quiet couple of weeks to start the year, but it certainly is not quiet now, and we're not going to hit everything that is on our list. But I thought we would start maybe just with oil prices, because we were pretty bearish oil last year, Rob, and it turned out we were right to be bearish last year. We actually got quite a bit of flack from people who were saying, no, oil's going to 100 barrel, 120 a barrel. Like, that was the general narrative. And it didn't happen. You sort of got it into the 90s, like in September-ish, and then it fell back down to where it was. And we've just been hanging out around 76, 77 Brent crude ever since then. And that's with the Red Sea shipping disruption crisis. That's with China. So what? It was a disappointing reopening. China's reopened. It's with the U.S. economy humming, better than most projections thought, and yet oil is still kind of hanging out there. And it's been an interesting week too, just because you can see a lot of posturing from a lot of different groups and nations around oil prices. The IEA came out with its oil outlook. OPEC came out with its oil outlook and put out a special piece about why they think peak oil demand is nonsense. You can tell that they have an angle there too. But maybe just start with, I know that you were seeing something more sort of short-term and tactical in the oil market. So maybe tell me what you saw short-term tactical, and I'll try and build a story around it.
Sure. It's very short-term and very tactical with that caveat. But we did put on a long position in oil in our tactical macro strategy. And really the setup is the dog that didn't bark, so to speak. So we're here today. Oil's in the low 70s, around $73 on West Texas crude. And what is the backdrop to that? The backdrop to that is we've just gone through a significant cyclical slowdown across 3 of the major economies: the U.S., the Chinese economy, and Europe. And that sounds weird to say, because everyone's saying, oh, well, isn't growth in the U.S. really strong? Well, it is, but the issue is the inventory cycle has been really in the dumps. The freight cycle has been really in the dumps for the last 2 years. All the things that are really levered to oil consumption have been depressed. And if you actually look, if you compare the total miles driven in the US by all vehicles, it's still below where it was pre-COVID. So you have this background where a significant number of people began working from home, and that is sort of leveled out at a much, much higher level than pre-COVID, even though it's down from the worst of the pandemic. And that's a longer term trend. Driving to work is about 30% of all the miles that people drive. So it's a really significant factor. And you have all of these things sort of coming together. Obviously, growth in Europe has been very weak. Growth in China, COVID shutdowns notwithstanding, has been very weak. So oil is down from last year, yeah. but it's at $73 a barrel. If you had said 2 years ago that that would be the backdrop, I think people would have expected oil to be absolutely tanking in that scenario, especially if you said, oh, well, EV deployments in China are growing in leaps and bounds. EV penetration is growing, multiple percentage points every year. That is a backdrop that you would expect to result in a major decline in oil, and it hasn't. And technically, it's digging in here. It can't go down. We had a brief burst at the start of the Israeli-Gaza conflict when people were pricing in the risks of a general regional war. Arguably, there's still some of that going on, but I think people have gotten a little bit bored of that. So what kills oil from here? Especially if you think, as we do, that the U.S. consumer, the U.S. cyclical economy, and especially the inventory cycle and the freight cycle is starting to bottom and come off the lows. That's a good recipe for oil, all else equal.
Yeah, and for me, the story behind it is very contested, and these narratives have always been contested when it comes to oil. But I don't know that I've ever in my career so far seen an IEA outlook and an OPEC outlook that were so diametrically opposed. And I spent the time to read through both of the reports. And, I'm reading hundreds of pages, listeners, so that you don't have to read them. But there were three key areas where the reports just didn't disagree at all. It's as if they were on completely different planets. So the first was, oil specifically, its share in road transportation and providing energy for road transportation. The IEA basically says that global road fuel use is set to decline from 2025, and that total oil consumption by advanced economies is already 10% below where it was in 2007, and that it's showing no signs of recovery. The IEA also notes that the only reason that oil use in 2023 surpassed pre-COVID levels, it had nothing to do with previous uses of oil. It's been driven largely by the petrochemical industry, and that is reshaping global patterns of oil consumption, and that has been driven by China. But I'll get back to that in a second. OPEC is not buying that. OPEC is saying, oil demand growth out to 2045, and it's talking about road transportation being one of the leaders of that growth there. So those are just diametrically opposed ideas about where we're going, both from what oil's being used for and what the growth rates are going to be from, the next 5 years out to 2045 is where OPEC is willing to go. And then the second is that both of the reports talk about how there's going to be a lot of non-OPEC supply that's going to come on the market here in the next couple of years. Brazil, Guyana, the United States, maybe some Kazakhstan, some Canada. But OPEC is expecting its share of oil production to increase from 34 to 40% out to 2045. And the IEA, it's not willing to get that specific with it, but it's clear from the report they're not thinking that OPEC share is going to increase. If anything, they're underscoring that the supply boost by these other countries are going to mean that OPEC is going to be less important and that there's probably going to be oversupply, so that the price of oil is going to continue to remain fairly low. And the last thing, just sort of the narrative here to tell, because this to me was the revelation and I think is really interesting. I mentioned the petrochemical industry. The IEA reports that between 2019 and 2024, China is going to add as much production capacity for petrochems as exists in Europe, Japan, and Korea combined. Europe, Japan, and Korea combined. And then the other part of this is also that U.S. producers are now substantially increasing exports of petrochemical feedstocks and intermediates and polymers. So China apparently used to get those things from Europe or from other places. They're now getting a lot of it from the United States. So much so that, ethane used in U.S. plants now accounts for more than 2% of global oil demand, doubling over the last decade. And the thing that is really so, and I guess just the last statistic there, huge volumes of U.S. ethane and propane have poured into China since the pandemic, approaching 3/4 of China's imports and meeting more than 1/3 of the increase in China's overall feedstock compared to 2019. But for me, the most interesting part of this is, we're hearing all these things about decoupling between the United States and the Chinese economies. And that's not happening in the petrochem space. If anything, and this is the language from the IEA report, there's a symbiosis between the largest global source of demand growth for oil, for the petrochem industry, which is China, and the largest global source of supply growth for the United States, which is allowing those petrochem sectors to flourish while European and other petrochem companies don't do well. And maybe we'll talk about Germany and Europe in the context of that. So I don't know that I quite have a story there yet. I sort of had the story in my mind last year that oil was going to go lower than people were thinking. But I see a lot more indecision there, and I wonder how you react to some of those data points, specifically the petrochem thing, because that blew my mind a little bit.
I have to think about that a little bit. I think it's striking that they're expanding their petrochem capacity so dramatically at the same time that they're making a really concerted effort to decrease, the demand for internal combustion engine cars. I mean, China has been far and away the leader in adopting electric vehicles. And that's largely because of government subsidies, sort of incentives that have been put in place to encourage that. And I think part of that has been creating sort of the basis for Chinese companies to sell into a domestic market and then go abroad. And we can speak more about China in a broader sense, but that's that finding new export markets, finding areas where they can build industrial capacity and have demand overseas. That's going to be a major focus for them. And that might be part of the petrochemical story as well. But the IEA and the OPEC thing is a little bit tricky. The only thing that I would flag on all of the assumptions about new supply coming on is if you take a corollary, which is infrastructure projects in the US. So there was a piece I read recently, a research piece, unfortunately I forget the source, that was talking about why has there been such a delay in US infrastructure spending. It's something everyone's been talking about constantly. The infrastructure bill, it's all coming, and it's a huge wave. None of this has really happened. It's been very, very slow to get off the ground. And one of the major issues is that all of these projects that were scoped out in 2020, when the stimulus was coming down the pipe, they've all had to be completely redesigned and completely re-budgeted because inflation has been so high in the interim that the economics are just absolutely different. So I think it's very difficult to make any plans with regard to supply growth in any kind of capex and labor intensive area like, bringing on a new oil field and drilling, because your break-even price is changing by the month. And that, that gets to the broader theme of just uncertainty and risk on top of everything else, sort of bringing up your discount rates and making it just more difficult to bring things on smoothly and to increase supply. And that itself is inflationary. I'm sort of jumping around, but those are some initial thoughts.
No, I take your point. And before we sort of springboard into some of our other topics, I mean, in some way, I take your skepticism of the IEA and OPEC, and I didn't even throw in the EIA because I find that they're wrong more than all the rest of them. But OPEC obviously wants a world in which there's more investment into oil and where oil prices are going up. So they want that narrative out there. And the IEA doesn't want that. They want a world in which there's more renewable capacity, and that's why they're usually touting the growth in renewable capacity in general. But maybe the demand side is a little more reliable here. There was a Morgan Stanley analyst who said that global consumption per capita has been remarkably stable at about 4.5 barrels per person per year since the late 1970s. And I think the place where OPEC has the argument by the horns is if you're arguing that we are at peak oil demand, or that oil prices are just going to collapse, or that it's not going to be a major part of the economy out to 2028 or that soon, you're basically saying that the way that the world has worked since the late 1970s is going to go away. And if you look at the demand level, like let's say, for instance, that China becomes a glittering future of only electric vehicles. We aren't even talking now about India, about sub-Saharan Africa, about the Middle East, about all these other places where there are just going to be more people. We might be declining demographically as a world in 2040, 2050, but not for the next 20 years. And it seems to me that's the more the more salient argument. There's a lot more work to be done to get to the IEA picture than there is the OPEC picture. The OPEC picture is more just extrapolating where we are from here and saying, look, there's all this political inertia. There's going to be demand. So there's going to be oil, and probably price will go up for the exact investment reasons that you talked about.
The other thing just to note is, because it's been in the news recently, is I know there's a lot of skepticism around EV adoption and the pace of that happening relative to where we were 6 months ago. And we've been calling this out, not to toot our horn too much, but this is something we've spoken about many times. One of the things that I found really intriguing in that whole thing is, aside from all the issues that we were discussed in terms of price and difficulty to charge and consumer demand not really being what a lot of these companies expected, all of those issues, the data point that really stuck out to me in the last month or two is the data coming in about how expensive it is to maintain an EV vehicle. And I'm not choosing my words carefully, because it's not to maintain. To maintain it is about half the cost of an ICE vehicle in terms of actually getting service, oil changes, that sort of thing. It's when you have collision repair that your costs are ballooning. So you're starting to see these anecdotes come out of people who get in a little fender bender in their Tesla, and it's like 20 grand to repair it because the parts are not easily available. The labor is very scarce. The number of people who know how to do that kind of work on EVs specifically is very low. That's a very surprising data point, but overall it means that the total cost of ownership is much higher than anyone expected, even aside from all those negative factors. So that's a real downer of a data point for EV adoption if you're rooting for it. But it's going to come into play here, because those estimates of the exponential penetration curves for EVs in the developed world, they're getting revised down again. And that's a big deal.
I think it also really depends where you are. If you're in a dense urban environment and there's good infrastructure and there's good roads in particular, leaving aside the mineral commodity issue, like EVs make a ton of sense. But I see lots of new Teslas driving around New Orleans, and those people must be in the shop every week. Like every pothole you hit probably dislodges some computer part or something like that. Like my shitty 2007 Honda Accord gets taken out by the potholes, let alone these fancy instruments that are precision based and things like that. And that article you sent around about, I think it was a Rivian truck that got back-ended, and it took, however many months and tens of thousands of dollars. I don't understand this idea that trucks and that farmers are going to be driving around EV trucks in the field like that, from charging stations to fragility of the issues to probably there's going to be even fewer parts in rural areas. And back in my hometown, Rivian's building a massive factory, and every single person I talk, and this is anecdotal obviously, but everybody I talk to from around my hometown is I'm not buying a Rivian truck. What are you talking about? That's, if you want to cruise around in the city, that makes sense. And then maybe just the last thing here, I think I said this, maybe I didn't say this on the podcast. So after we had that, Ben Shepard came on and talked about the Democratic Republic of Congo and the elections and everything else there, he recommended King Leopold's Ghost, and I've already powered my way through it. And man, is it depressing to think about the level of just awfulness that is probably happening to mine all these mineral commodities. Because the King Leopold's Ghost talks about rubber in particular, tin, some of these other mineral commodities that were in Congo at the time, and the things that European powers and Western powers did to harvest all of these resources. Just really depressing. And I imagine that things have not changed that much when we're talking about the mineral commodities that have to go into these EVs. So, the other saving grace of EVs is that you might feel like you're saving the planet. And I don't know. I don't know how you can make that argument, but maybe we shouldn't go off down that hobby horse. Maybe let's turn, Rob, to China, and you're going to have to lead the way here, because it has been such a busy week geopolitically that, I've been focusing more on things which is, China adjacent, but Taiwanese elections and shipping in the Red Sea. But I know that there have been some economic issues in China that you've wanted to flag, and they are really geopolitically important too. So why don't you lead the way on the China conversation, and I'll fill in the gaps.
Sure. So a few big things happened this week. The first is at Davos, the Chinese premier. I think it's the new Chinese premier, Li Chang.
You knew.
Am I pronouncing that right?
You're asking the wrong guy. I can pronounce the names of these Houthi militants if you want, but for Chinese premiers, you're going to have to find another expert.
Well, the premier of China, we'll just say that, he said at Davos very clearly that they do not have an interest in doing stimulus, right? And this is an interesting development, because the background to this is that the financial media and investors have been claiming for months and months that, they're going to roll out stimulus. We're all going to get long Chinese equities because stimulus is coming. And he came out and effectively put the kibosh on that finally. So that was one thing that happened. The second thing that happened at the same time, simultaneously with this, was Hong Kong stocks made a new multi-year low, and really just, the bottom fell out of that market. So as we speak, Hong Kong stocks are digging in today, but relative to the rest of the world, all-time lows, I believe, and they're back to the absolute depressed levels of the early pandemic period when everything just got puked up and sold off. And really what you're seeing is capitulation. You're seeing the group of people who were playing for Chinese stimulus as a good thing. They're capitulating and saying, my thesis is wrong, and the equity markets are reflecting that. So there's a few things I just want to go into here. The first is, we've been very negative on China, and it was in August 2022 when we did a special podcast just on this and said this is the biggest thing that no one is paying enough attention to, because the news cycle is all over on other things. And that has played out in spades. Last year, property prices were down 10%. New property starts were down 20% year over year. The bottom is starting to really fall out on the property market in China. And that is what it is, and that's not going to change. I think the thing that's interesting to talk about is, what are the implications, and how are investors misinterpreting what needs to be done and what is being done? Because I think there's a lot of stupid things that are being said publicly, and because I don't know these people from Adam, I'll just quote them directly. But it's worth thinking about, because it's very relevant to understanding a lot of big things that are going on from an investment standpoint, and also from a geopolitical standpoint, because there are echoes with Japan in the 1980s and sort of the problems that they had to deal with. But just a few quotes that I pasted from the media. These are just from Bloomberg today. And here's one quote from some economist on Wall Street. They need to cut rates if they want to reach 5% growth this year. They're making the same mistake as the Bank of Japan did in not reacting to deflation in the early 1990s, when that nation was beset by a prolonged period of poor economic growth. They need to move, meaning they need to cut rates. They need to juice monetary policy. And then here's another chief China economist at Morgan Stanley. Quote, "This is what we call reactive easing. They need a more decisive shift to active easing to break this debt deflation loop." So this is the narrative that's out there, is basically they're not juicing the economy with enough credit, and that because of that, they're going to fall into deflation. And this is frankly just really stupid, and it's wrong. And here's two reasons. The first is, it's taking a rich world playbook and applying it to China. It's taking the US playbook and applying it to China. The problem with Chinese credit growth is that credit does not go into consumption. Credit does not spur end demand. It spurs investment. And what the premier basically said at Davos is, we don't want to, juice things in the near term at the expense of making things worse in the longer term. And that's what happens when you have credit-driven investment, because the problem is overcapacity. There's too much supply, relative to demand. So the notion that expanding credit, being more aggressive, is going to end this debt deflation loop. It's going to actually make it worse. So in this regard, I think the Chinese are being somewhat smart, and that what everyone wants them to do and is playing for them to do is very wrong-headed. The other aspect of this is, on the deflation side. So Chinese CPI readings have been very weak and moving into deflation recently. It's not all bad, though. So like one of the big portions of that CPI is pork, for instance. So if you remember in 2018, I think it was, when we had the African swine flu, one of the reasons why that happened was because the Chinese pork industry was hugely inefficient, and it was all these tiny producers, and there was no control. And when the flu started to spread, they were all trying to basically hide it and sell their pork and put it onto markets before they got caught by the regulators. It was just a mess. And in the interim few years, they made a concerted effort to consolidate the industry, to professionalize the pork industry, to get kind of the small farmers out of there. And some of that is, kind of creepy from a animal welfare standpoint. But at the same time, it means that Chinese pork, which just hit a 9-year high in terms of the volume of production, Chinese pork is just being produced more efficiently, more productively. That's something that, households are eating all the time. It's a major staple. So to look at something like that and say, oh, this is a debt deflation loop, it's sort of misreading the situation in many ways. There's good deflation and there's bad deflation. And that's not to say, I'm not turning around and saying, oh, I'm very optimistic about China for those reasons. But I do think the whole narrative is completely wrong with regard to what's happening there. From a market standpoint, as I said, I think things have gotten overdone in the near term. If in August 2022 we were saying, hey, we're getting the hell out, and we think you should too, we put on a long position in Hong Kong today in our tactical macro strategy. And that's not a big fundamental medium-term call on China, but it's a call on the narrative changing because the current narrative has been thrown out and people are looking for new ones. And if you look at valuations right now, like HSBC, which is sort of the traditional Hong Kong bank, trades at 0.4 times tangible book value. So just to put that into context for people who aren't financial analysts, that's extremely cheap. That means it's trading for less than the net value of what's on its balance sheet, which means that the market is assuming that what's on its balance sheet is just absolute garbage and it's going to be all, defaulted and very, very low quality assets. Ping An Insurance trades at 0.8 times tangible book value. That's a health insurance company primarily. So the valuation, the sentiment is really, really depressed. And I think it's due for some kind of turnaround, some kind of shift in narrative at this point.
You were kind to say that we've been right about China for the last year, 18 months or whatever. You've been right about China for the last year, 18 months. I have been wrong because I have been more optimistic. And this is a good place where it's good to check your geopolitics with somebody who actually knows what's going on in markets. Because if we had led with geopolitics, we probably would have gotten it wrong. But you had the better argument and it won out in our internal research teams. And that's why we were correct in the end. So thank you for the charity. But I should say that that was all you, and you should take the victory lap on that one. Also, a funny story about African swine fever. I don't know if it is a flu or if it's anyway, but it's ASF. I was speaking at an event in 2019 in Canada, and I made the mistake of calling Xi Jinping a dictator and of calling China an authoritarian regime. And there was a Chinese analyst in the audience who spent the rest of the day following me around trying to correct me that Xi Jinping wasn't a dictator, that really China was a democracy. I didn't know what I was talking about, blah, 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 until somebody went on stage and said, hey, we're doing some research on a vaccine for ASF that will be able to inoculate pigs against this disease in the future. And I don't think they actually got to the vaccine. I think Vietnam and the United States announced a vaccine vaccine or a successful one maybe a year ago or something like that. But they were talking about the research at the time where they were going. And I was so grateful to that speaker, because after that speech, my little Chinese follower, I was not important enough. There was no ideology that followed that person for the rest of the entire conference, trying to figure out what was going on with the ASF vaccine. And then the last thing here with the narrative issue, I think the narrative is going to be tricky to thread, because a lot of it is going to hang on the U.S. election. We are very clearly in a period of U.S.-China détente, and I'll take the victory lap on saying I did get right that the U.S. and China were going to have better relations. When people were talking about another Taiwan Strait crisis around Pelosi, like I was out there sort of on an island, forgive the pun, saying that things were going to get better. But if we were just taking if U.S. elections were held today, I mean, probably Trump, and that's going to be very, very bad for U.S.-China relations, and all sorts of things are going to follow on from that. But I sort of take your point there. The last thing, and I'll just sort of sprinkle in the geopolitics on top, part of the reason I haven't been down in the weeds with the Chinese economy this week is because everybody wants to talk about Taiwanese elections. And this is a place where I really think the media is framing it and getting it wrong. Because the headline is, DPP wins again. And not pro-independence is too strong, but the Taiwanese political party that wants a more independent relationship from China, which is not on board with what China wants, they won another presidential term. I think it's like a fourth consecutive term or something. It's unprecedented in Taiwanese politics. The real story is twofold. Number one, that DPP lost its legislative majority. So they're not going to be able to govern like they did for the last 4 years or however many years. And then second, we've had the emergence of a third party in Taiwan's democratic politics for the first time. So the way it usually was, it was DPP on one side, KMT on the other side. KMT was more pro-Chinese, DPP was more pro-independence. I'm painting with a very, very crude and large brush, but that's what it was. Now you have TPP, which is rising, not the trade agreement, but this new Taiwanese party, led by, I think he was a former mayor of Taipei who seemed to have more in common with the DPP, but on the campaign trail was being more pragmatic and talking about being a little bit friendlier with China. If you are Xi Jinping, I'm just guessing here, I don't think you give a shit that the DPP won a presidential election. You are probably much, much happier that A, they lost their legislative majority, so they can't govern with as much confidence as before, and B, you now have a third party that you get to play off the other parties within Taiwanese politics. And could you fracture Taiwanese politics even more so that you have multiple other parties that you could play against each other? Is it the best case scenario? No, the best case scenario is that Taiwan kowtows to the mainland. It says, we want to come back, thank you. Like, best case scenario for me is that $1 billion drops out of the sky and that I never have to record another podcast again. But, if we're in the real world here, things actually, I think, if you're thinking of a long-term strategic perspective, this was not necessarily a negative for China. And it's good, I think, for markets because it underscores what we've been saying here for a long time too, which is there's not going to be a Chinese invasion of Taiwan anytime soon. So I think the narrative that will challenge what you're talking about is if Trump emerges very clearly as the front runner, and if his first call or one of his first calls, as it was when he won the first time, is to Taiwan's president, and he's doing all these things, suddenly you could see a real breakdown, and things might get disconnected from things like book value and things like that. But if we continue in the détente and things are going to be fine with Taiwan, at least geopolitically, things look a little bit better, but not for the reasons I think that for most people are talking about.
Well, I think the elections are particularly relevant because just getting to the Chinese balance of payments and how that relates to geopolitics and how it relates to the balance of power and how it relates to trade policy. One of the most striking data points in the world is that regardless of everything that's gone on, regardless of the fact that Trump was first elected in 2016, I mean, that's years ago now, and tariffs have gone up, and the whole narrative has changed. In the interim, the Chinese current account surplus is bigger now than it's ever been before, both in dollar terms and both as a percentage of the global economy. And that is the elephant in the room, because when you think about how that shift is happening to a multipolar world, as you've talked about, the U.S. is talking sort of more of a multipolar game, so to speak, more of a zero-sum kind of game, and yet their policies and the flow of the dollars is still, the U.S. providing that destination of last resort for the world's, capital flows, which correspond to trade flows. So China is in a real pickle for that reason, because, getting back to investment growth and EVs and that sort of thing, they need to shift to economic activity that's going to have, productive value. And that's one of the things that the premier was mentioning at Davos. Like, look at how we've done. We haven't pulled out all the stops on stimulus, and we still managed to grow last year because of EVs and infrastructure and, chips and sort of the hot button topics. But the issue is, without the domestic demand to soak those things up, by definition, you need a broader current account surplus. You need a trade surplus with the rest of the world, and the rest of the world has to soak up the demand for those. So the cover of The Economist has a wave of Chinese EVs flying toward Europe because they're coming to conquer the European auto market. Expect to see more stories like that as China tries to maintain growth by shifting capital allocation without changing the underlying imbalances. That's going to cause trade issues. It's going to cause problems. And I would expect the rhetoric is going to get more heated rather than less, because that's what they're trying to do. Whereas Japan, just to use that comparison, because the comparisons are very similar, Japan in the 80s, China today. Japan, in some sense, turned inwards, and they were renowned for putting in place sort of accelerated internal investment, building bridges to nowhere, paving roads in the middle of the countryside that no one drove on. It was like the New Deal in Japan, putting people to work just to try to boost domestic demand, and that didn't work. So will China find a different path to get out of sort of the situation that they're in? I'm not super optimistic about it, but they're not doing exactly the same thing. And what they're doing is something that's unlike Japan, which was the boogeyman in 1990. What was the movie with Michael Douglas where I think that was the peak of Japan phobia, where it was like a murder mystery, and it was the Japanese businessman who was behind it because they were taking over the Los Angeles business community. And anyway, early 90s Japan stuff. But after that point, Japan became cute and cuddly, and, Totoro and PlayStations, and, they moved in a direction that was not threatening to the global system, which was a huge contrast in the 1980s. I don't think China is taking that route. They're trying to seek overseas markets to sop up the production that they need to grow, and it's going to cause conflicts.
Remember, I worked with George Friedman for over a decade, whose first book was, his second book. His first book was, his dissertation was on the Frankfurt School, which is very interesting if you want to read. But his second book that made him a geopolitical analyst was The Coming War with Japan, which George would tell you that he got it right. He just got the timing wrong. He's still waiting on the coming war. But that was written in the early 90s. In some sense, I wouldn't have a career if there weren't Japanese boogeymen out there to scare up. So thanks, George, and thanks, Japan. I appreciate it. Quickly, let's just touch on what Emmanuel Macron said at Davos before we take some questions and answers from the listeners. I, as a rule, try to avoid stupid statements at Davos, but Macron hasn't been there in a couple of years, and you just finished reading a de Gaulle biography, so let's indulge.
Well, he hasn't been there since 2018. And for those who don't follow French politics closely, Macron is sort of, he's in the final stretch. So last year was viewed as kind of a negative year for him. And by his own standards of hyperactivity, the last few months of 2023, he kind of didn't do too much. And everyone here in the journalism and media world has been saying, like, oh, what's his next move going to be? Because clearly he's gathering his strength and figuring out what to make his final push with his political capital for the last few years of his term. And he came out and he, for those who don't know, he appointed a new prime minister who is the youngest prime minister, I believe, in France's history. He's only 34 years old.
Younger than me. How about that? I could be prime minister of France.
Yeah. What? Sounds like a great job. So he went to Davos and he started talking about Euro bonds, about joint defense, about putting together sort of sovereign European-backed financing structures to make the necessary investments that Europe needs to remain competitive and to build its own security. And I think it's TBD with regard to how serious he's going to push on this, and maybe this is just something he's cooking up for the international audience of Davos. But I do find it interesting. I saw something recently that Macron had a copy of de Gaulle's memoirs on his desk that he was showing off, that he was reading. And I did just read a massive biography about de Gaulle, which was a slog at times. And it was striking to me how a lot of the incentives and the setups are very similar to de Gaulle, in the early 1960s, trying to navigate between the twin peaks of the USSR and the United States and create sort of continental Europe as its own independent power with its own defense capability. His distrust of Germany as a reliable partner. I think that's sort of where we're going to some extent now as the German coalition careens from, fuck up to fuck up, frankly, and sort of slides into irrelevance. I don't know. I just wonder to what extent he is going to try to push on that as his lasting legacy and put in place some kind of framework for a French-led, structure of combined defense, combined investment, combined industrial policy.
He's going to try, and he's right. Like, Macron is the smartest, for my money, is the smartest geopolitically leader in the world, certainly in the Western world that's been democratically elected. He just, he has trouble expressing it in a way that makes people want to agree with him, and France doesn't have as much power as he wants it to have. And in that sense, there are also interesting corollaries with de Gaulle. De Gaulle gets the halo of military hero because of what he did in World War II. But he was a weird dude before World War II. I commend you for getting through the biography. I stopped halfway through, but I was struck at how weird de Gaulle was early in his life, how strange he was even after he was France's hero and all the difficult things he had to do. But he's got the right idea of what you want is for Europe to rise as its own power. It's going to hang on two things. Number one, France and Germany have been talking about serious European Union reform this year, and talking about getting that not over the goal line, but at least like getting it on the table, talking about it seriously, and not piecemeal stuff, like things that would be, treaty changes or really changing what membership means or changing unanimity when it comes to decisions. We have to see progress on that if anything that he's talking about is going to come to fruition. That's number one. The second, and this is the flip side of what we were talking about with China, a Trump victory would be a godsend for what Macron is talking about here, because it would wake those Europeans up to the United States not being a valuable actor. Maybe you are a reliable actor. Maybe you get back to U.S., EU trade war that was happening during the Trump administration. So in some ways, if what Macron wants is, political impetus for the changes that he's talking about, he needs probably that kind of external threat. And as we saw with the Russia-Ukraine, it wasn't the Russia-Ukraine war. The Russia-Ukraine war and COVID were not enough. It moved the EU some of the way there, but it's going to take something like that, like a complete loss of faith in the EU, in NATO, or a complete loss of faith in the United States, I think, to move it forward. So that's what we've got there. All right, let's move to some questions and answers before your beautiful daughter wakes up here. Thank you to all of the listeners that wrote in. We appreciate you doing that. You can tell that I'm buying time as I bring the questions up in front of me. And yes, here we are. Okay. So first, from @GovBear90, I should figure out your name @GovBear90 because you like a lot of tweets and I appreciate you. Is the Red Sea crisis going to bring back a resurgence of inflation in the United States? Thanks in advance. I'll let you take it first, Rob, because I know you had thoughts.
Well, you're already seeing it. as we spoke about, I think 2 weeks ago, container shipping prices have been rising just to reflect the fact that ships are going around the Cape of Good Hope. So you have this sort of direct impact. Like all else equal, as we mentioned, the freight market has been really on its ass and very weak. But even in spite of that, this is starting to provide an inflationary tailwind just because of the physical act of taking a longer time to get the stuff where it needs to go. But the more interesting and probably more profound side of this, I think, is sort of what it says about the U.S. as a security guarantor. And we've spoken recently about the strange delay in terms of the U.S. actually stepping in to try to, actively protect these ships, to strike back against groups that are firing missiles. And that's still going on today. There was a ship that was struck overnight near Aden, and this is happening right now. It's been weeks, and the thing that I find very interesting is you're starting to see markets price in not the physical displacement of the ships alone, but also the increase in risk. And that is something I think is more subtle, but much more important. Is so much of supply chain is about risk. And for example, if you look at the premiums in London, on the London insurance market, to insure ships that are going through the Red Sea, they're skyrocketing. And on every ship, the benchmark rates on shipping insurance premiums have been rising very rapidly in recent weeks. And to the point where if you are even trying to go through the Red Sea, you have to provide a special bulletin to your insurance company to tell them that that's going to happen. So this is a very specific issue, but it also reflects the fact that when there's friction, risk goes up, and that increases the inflation for everyone. And it's a self-reinforcing sort of issue. So before we talked about EVs and how they're so expensive to insure, part of that is because there's just not a very well-developed supply chain for the parts because the volume of EVs is still very small. So when there's not a well-developed supply chain, there's not reliability, there's a lot of friction, and the cost to repair goes up, which means that insurance costs on EVs are way higher. So there was a piece in the journal that said, let me see if I have the number here. Here we go. Insurance premiums on EV owners average $357 a month compared to $248 a month for people with ICE cars. And that's sort of a weird little route to go into, but it just shows how when you have these sort of geopolitical events, these sort of conflicts that emerge, and they don't get stomped out, and you don't sort of bring the confidence back that they're going to be stomped out as soon as they emerge in the future. Like what you're seeing there is basically the pricing of U.S. uncertainty, uncertainty about the U.S. Security umbrella. And that I think is what to focus on even more than the physical issues.
Couldn't have said it better myself, and I'll say two more things in that vein, since I think you covered the Red Sea particularly well. The first is this is not the only critical event or sense of instability that is happening at a key choke point in the world. Unfortunately, we have to go back to the middle of Eurasia and Azerbaijan and Armenia this week. And this is something we've talked about on the podcast repeatedly over the last 12 months, and how the Russia-Ukraine war has closed airspace in large parts of Eurasia. So there's this very narrow air corridor over the Caucasus that you have to go through if you're flying in this area. And on January 10th, Azerbaijan's President Aliyev gave an interview where he talked about Armenia, his relations with Armenia remaining deadlocked and maybe even getting worse if they didn't open up a route called the Zangezur corridor. I hope I'm not mispronouncing that. This refers to an Azerbaijani exclave inside of Armenia. So it's majority. It's not majority. It's Azerbaijani territory, I guess, but it's within inside Armenia. It has no land connection to Azerbaijan itself. And we already saw Azerbaijan take back Nagorno-Karabakh this year. They brought up, well, we want a land corridor to this other place, Nakhchivan, too. but they didn't really push on it that far. And Armenia came out and said this week that his remarks were absolutely unacceptable, that they were a blow to the peace process. The Armenian prime minister was actually kind of tongue-in-cheek. He said he promised a financial reward to anyone who could find the term Zangezur corridor in their November 9th agreement. Well played there. And Russia even spent some time weighing in. So Russia's foreign minister, and Russia's been very, very pretty weak in its support of its ally or supposed ally Armenia here, but came out and said this corridor is not in the agreements with Azerbaijan, so we don't exactly know what Azerbaijan is talking about. So maybe just a little back and forth, but some little political bubblings there that you should worry about in terms of global supply chains. And then last but not least, I'll dovetail this with Pinecone Macro Chase Hello's his question about thoughts on the Iran strike in Pakistan. So Iran struck some targets inside of Western Pakistan a couple of days ago. Pakistan, we're recording Thursday, January 18th, struck back at a couple sites in eastern Iran. I'm not too worried about it. Western Pakistan has long been sort of this lawless place, and you get attacks back and forth. I will say the intensity of this attack and the need for Pakistan to express a tit-for-tat maneuver, that's sort of new. We don't usually see it escalate to quite that level. Pakistan is already saying, okay, but we're done here. Like, it should be peaceful mediation from now on. We just felt like we needed to make sure that Iran didn't feel like it could just bomb targets inside of our territory with impunity. So it should, if things were normal sort of geopolitically, it should be sort of, okay, we had a tit for tat, now things will calm down. But this is the other side of the Middle East, and the Middle East is very, very hot right now. So I wouldn't give you the all clear there, but I would tell you that most history tells us that this is not outside of the bounds of what's usual for Pakistan and Iran. And I would expect that they'll get back to normal and to Pakistan getting oil or whatever else they want to get from Iran going forward. Another question from Byzantine Emporia. What's the most under-discussed major story of the past 6 months? His example, or I'm sorry if you're a she, but I think you're a he. Does Myanmar move the needle at all for you guys? So you give your answer and then I'll give mine.
So I'll focus on purely markets, and then maybe you can do a geopolitical one. I think the most under-discussed story in the last, maybe not 6 months, but 12 months for sure, has been the incredible performance of energy stocks. This is something nobody is talking about. But the thing that is so striking is if you look at the performance of energy relative to the market, it's been in a 15-year downtrend. Like, it peaked in 2008, and since then it's just been down, down, down at a very stable and steady downward trend line. And after 2020, in 2021, we saw that surge. That trend line was broken. No one has really discussed this, but if you look at the comparison between energy stocks and tech stocks from 2021 to today, everyone talks about tech and semiconductors and, the sector's on fire. And energy has outperformed tech during that time period. No one is talking about ExxonMobil. No one's talking about Chevron. Those have been screamers. So I think it's interesting both because it's been so ignored, but also because of what it says about, getting back to our crude oil discussion, about energy demand and about the outlook there. Are we shifting to some sort of a new paradigm that's different from what we saw from 2008 to 2020? All you have to do is look at the shape of that chart, and it suggests that we are. And that's really important.
My answer, as maybe you've come to expect if you know me well now, is that the stories that are going under discussed, and Myanmar is one that we could shine a light on. I've tried to shine a light on what's going on in sub-Saharan Africa here. I think all of these things are important, but it's the positive stories, I think, that don't get discussed enough. And for me, the two most positive stories of the last 12 months, 24 months, it's Brazil and India. And we talk a fair amount about Brazil on this podcast too. Just the changes that are happening with Brazil politically, economically, the growth levels that we're seeing, the way that Brazil is elbowing out a lot of competitors in a lot of different areas. Like, Brazil is a very, very positive story. You've got, a regional size power that is really coming into its own, and a power that everybody was expecting to come into its own for centuries and finally looks like it's putting things together. That's an incredible story. It's one that's going to unfold over the coming years, and that's not what we get when we get Brazil coverage. We get Lula said this, or Bolsonaro said this, or this crazy thing happened here, or the favelas and the druggies are here. Not the real, the more boring, but the more tangible story of, hey, Brazil seems to be coming into its own. And ditto that for Indonesia. I mean, Indonesia is a country that gets even less coverage probably than Brazil because it doesn't have a bombastic, flamboyant leader. Jokowi, if you pay attention to him, he actually is very interesting in his own right, and he seems to be trying to start a little political dynasty of his own. But 5-10 years ago, Indonesia was the red-headed stepchild of the IMF and the World Bank, and they were too protectionist, and they weren't doing all the things that the Washington Consensus demanded that nations would obviously do if they wanted economic growth. They bet big on a multipolar world. They bet big on vertical integration and not allowing investment at these other things into their market unless you brought technology and commitments and all these other sorts of things. And it seems to be paying off. You put this in the Knowledge platform this week, and I think it's an unfolding story over time. And it's something that my mind changed about in the last 12 months too. In our strategic wealth story, when we first started doing strategic wealth, I was negative on Indonesia. And then when I started paying attention to what they were doing and how things were changing, A, I started paying a lot more attention, and B, I changed my tune on it from an investment perspective. So I would say that more than anything else, it's the positive stories that get muscled out in general. In particular, at my level, it's the stories in Brazil and Indonesia and places like that that go underreported in general. Rob, I think that your daughter is trying to wake up, or maybe we should give her some peace and quiet. And we've gone through the questions that I've got right now. And if we didn't hit your question, don't worry, we'll get them in the future, and you can always tweet at me or email me if you want to. So on that score, anything to say about Cromwell before we leave, Rob, or no Cromwell updates this week for you?
No, I'm not on my English Civil War kick anymore. I'm sort of going into other obsessions. So expect to hear from me on Charles de Gaulle, or I'm getting into Japan again, so I'll be ready to talk about Japan a lot more.
Well, the listeners who come here for the Cromwell insights, I'm sure will be disappointed, but I think the podcast will do just fine. So get out of here, and we'll talk to you later. Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.